A simple investment was made when a child was born that ended up funding her entire wedding. Today, I'm joined by Deepak R Khemani, who has spent over 4 decades helping people make smarter money decisions. This episode is full of real stories, hard lessons, and simple ideas that can completely change how you handle money. So stay tuned till the end.
Hi everyone, welcome back. So, sir, your public content sits at an interesting intersection of money, motivation, and storytelling. So, I want to start one level deeper than investing strategies. What made you care so much about helping people understand money in the first place?
Thank you, Mihir, for inviting me to this show of yours. So I was born into a family where my dad's job was a financial advisor. He used to knock door to door, meet his friends, relatives, tell them that it's always a good time to keep some money aside and plan for your financial goal. He saw my dad doing this, working, meeting people, filling in forms, collecting money from people, getting it deposited. And the day I became 18, my dad told me, I have built this business over so many years. It's your job to now continue. And so I've been doing this for 41 years.
I've seen a lot of your content, but one thing that comes out is like, why does storytelling help people understand money better than just raw numbers?
Yeah. So, for some reason, the education industry or the personal finance industry or the industry which is involved in helping money plan their finances somehow relies only on numbers. This scheme has given 12% returns, 6% return is the pension you should be withdrawing, or 4% is the safe withdrawal rate. Most of us do not understand numbers. So let me share one real life story. A distant relative got married and he was blessed with a daughter. My dad reached his house and congratulated him and made him understand that you have been blessed with a daughter. Some 18, 20, 22 years later, he will grow up. He will need money for her financials, for her higher education. Probably you want to get her married. Why don't you start a simple small investment plan wherein you pay an X amount every year and then it will grow to some money. And just because my dad was elder to him and he couldn't say no, he agreed, signed the forms, and that journey started. 21 or some 22 years later, he came and met in our office, and he fell to my dad's feet and then gave him a box of sweets. And he said, "You know what? My daughter is getting married, and that plan, investment plan, which you had started for her when she was born, has now come useful to us because we can use that money in her marriage." Now, this real life incident actually happened in front of me. And whenever I meet people who've been blessed with a child, or I'm making them understand the importance of starting early, especially for your children, higher education or marriage, when I give them this example, this is something which I have seen through. And when I use this story to tell them, it is relatable. Imagine me telling you invest 1 lakh rupees, or invest $1,000 every year, and at the rate of 6%, 20 years later, it will become whatever. Numbers and a real story where you actually shared a real life incident where a person invested money. When it matured, it came to his hands and he used it to get his daughter married. That really helps. We've been growing up with stories.
Yeah, I think storytelling is really important for this generation. I think books and stories are the things that will keep us, going and grounded. So yeah, I think that's a fantastic thing that you are doing. So sir, one theme that keeps coming up in your content is compounding. So why do you think so many people intellectually understand compounding
Yeah.
but are still not able to benefit from it?
So that compound, we've heard the famous equation, the famous quote by Einstein, which says, "Compounding is the eighth wonder of the world. Whoever understands it benefits from it. Whoever doesn't, pays for it." So there is this classic example which I share in every meeting, every session, every program I take, where people tell me, "You know what? How do I understand compounding?" So the example is like this. I'm giving you 1 rupee that is going to double every day for 31 days, or I'm telling you, here is 1 crore rupees. Take 1 crore rupees from me, or take 1 rupee that will double every day for 31 days. What will you choose without using a calculator? And a lot of people choose 1 crore rupees because 1 crore rupees is a lot of money. However, if you double 1 rupee every day for the next 31 days, after 31 days, you get 107 crore rupees. 107 crores versus 1 crore. Imagine what is going on. Our brain has evolved in such a way that it is difficult for it to understand geometric progression. It doesn't understand the exponential function. It understands the linear function. So that is the problem. Nobody understands compounding.
If you're finding this useful and you want to learn how real people actually build financial freedom, I share conversations like this every week. So please hit subscribe. It really helps me bring more guests like this. Right. I think beautifully said, sir. So, sir, you said that financial freedom is a lifelong fight. So, why do you like to frame it that way?
For some reason, people believe that financial freedom is a number. When I have, $1 million or $5 million, or in India, let's say if I get 1 crore rupees or 5 crore rupees, I will live very happily ever after. I believe that is not the right way of looking at financial freedom. Financial freedom can never be about a number. There are multiple aspects to calling yourself financially free. One, you are no longer working for a salary or money which is coming to you on the first or the fifth of the month, which will take care of your monthly expenses. So you have multiple sources of possibly passive income and maybe even active income, which is coming to you regularly. They say that you should have 5 to 7 sources of passive income. This was part one. The other part is a lot of us throughout our lives, especially during our younger and middle age, will keep on working odd hours, extended hours, just to make that little bit more money so that you can save and invest it so that you can retire early. Now, chances are this is coming at the cost of your health. Let's say you are 45 or 50 years old and you have achieved FIRE, as they call it nowadays, financial independence, retired early. But if it has come at the cost of your health, if you are taking medicines and tablets and you've got lifestyle diseases, and if you can't enjoy the money you have made for yourself, are you really financially free? So one, health is a very, very important part of financial freedom. The other part is time. I tell people that if you have time to do your own thing, if you have time to chase your passion, if you have time to do the things you have always wanted to do, along with money, which will see to it that you are able to, fulfill all your passion, that is financial freedom. So if I'm in Mumbai, let's say I'm in Mumbai and I have a family of four, me, my wife, and my two children, I would then calculate one in numbers. My current monthly expenses are these. My current yearly expenses are these. And if I can calculate that I'm going to be living for the next 20, 25, or 30 years, and the money, the investments I have made, or the passive income I am generating can take care of me today, next year, and inflation adjusted every year for the next 20, 25 years, I can safely say that I have arrived. I have reached the point of financial independence or financial freedom. I don't think it is a number, because a person living in Mumbai may get a different number. A person living in a small town or maybe in a village in India may have a totally different number, and all of them can call themselves financially.
Right. So, sir, let's try to explain that you said earlier in your first point that if you have multiple sources of income, then you are probably closer to financial independence, right? So, can you talk a little bit about that?
So one, most of us, I always give this example. God gave us one hand and there are 5 fingers. All 5 fingers are different. And it is because all these 5 fingers are different that the hand gets that power, that fist becomes powerful. Similarly, when you are planning your money, I meet a lot of clients, I meet a lot of people who for some reason are overextended in one particular asset class. People say that, I became a millionaire by investing in real estate and all my money is there in real estate. I get rental income, but the property prices always keep on going up and my life is settled. Similarly, I get to meet a lot of people who say, you know what, I'm an equity investor. All my money is there in the stock market. I don't need to bother. The stock market has made enough money. If you have some money, distribute it evenly across different asset classes. Have some money in the bank, have some money in real estate, of course, have some money in stocks and mutual funds, have some money in commodities, silver, gold, oil, whatever you feel works for you, and always have some cash in hand, some emergency fund, some money that you can dip into when you need it. So you need to plan it in such a way that your money is invested at different places, and depending upon how you have planned it, you have 4 or 5 sources of income, which means if there is a downturn in real estate, that will get compensated by your stock market or your mutual fund investment. whether it is active or passive. You always need to have multiple sources of income.
So what does a good financial plan look like?
Okay. So let's take two or three situations. Let's take a situation of a person who is alone. He is the only person who is earning member of his family. He has responsibilities for his family. A financial plan for this person will be different from a person in which, in a family in which there are two people, husband and wife, possibly both working, they don't have children. The financial plan for a person who is 55 years old and closer to retirement, he has children who are possibly taking care of him, that becomes a different financial plan. However, there are these 5 or 7 points in financial planning which I tell are applicable to everyone. Let's take plan number one, part number one, these 7 points. One, always have an emergency fund of between 6 to 12 months lying at a place where you can access it at the press of a button. What is point number two? If you are the person in the family where the family depends on you, upon your income for sustenance, you need to have enough life insurance. Now, for some reason, the understanding of life insurance in the Western world seems to be a little bit better compared to countries like India, where the first thing when you tell people buy life insurance, they say, मैं थोड़ी मरने वाला हूँ. I'm not going to die. It's not about dying now or dying later. It's about protecting your family. So we've talked about emergency funds, we've talked about life insurance, we've talked about health insurance. One part which we already discussed before this was planning your finances in such a way that you have multiple sources of income. Plan your finances right from the day you start earning, that you have two or three sources of income. One may be your primary source of income, maybe your job, your profession, your business, whatever you're doing. Have a side hustle, do some consulting work, do some online work. Let's take the next important point, asset allocation. A lot of people, for whatever reason, keep all their money in one particular asset class. We understood real estate or stocks or whatever bond. The first lesson we were taught when we were in children in school is never keep all your eggs in one basket. So whenever you are creating your portfolio, see to it that you are well diversified. Second last one, always have an advisor. A lot of people in today's generation, especially they say Gen Z, these people are more aware. They are on social media. They want everything on their mobile. Everything is on their app. They can decide what to buy, when to sell. But chances are, if you don't have a long-term mindset, financial planning is, whenever we talk about compounding is long-term. It's race to end. It is all about time. And the point number seven, which again a lot of people miss is, for whatever reason, they do not create a will, they do not create an estate, they do not create this document that tomorrow, if something happens to you, what should happen to your money, what should happen to your estate, what should happen to the portfolio, all the money which you have created in your life. This is one document a lot of us miss to do. And whenever you start this conversation, I have had this difficult conversation with a lot of clients. When I ask people, have you made your will? I'm not going to die
Mm.
today. I'm going to live long. Why should I write a will? No, nobody knows when you are going to die. You may go to sleep tonight and you don't know whether you're going to get up tomorrow morning. So if these 7 points are taken care of, you have a
Yeah.
financial plan in place.
Yeah, I think that was a very detailed plan, sir. Thank you so much for putting it out there. So we've already talked about what people should do. Now, in your experience, what are the biggest mistakes you see people make when trying to build wealth?
So I will tell you the mistakes I made when I was starting out, because at that time, I told you there was no concept of a financial planner or a financial advisor. You just did things that everybody else was doing. You read the newspaper. I remember the day the Twin Towers were hit, markets were already down, and the day Twin Towers were hit, the next day the market opened, there was complete panic. Everybody was selling. Why? Because two planes crashed into the Twin Towers in the US, and it now seems the end of the world. I had a small portfolio of stocks, and one of that stock portfolio was considered a blue chip at that time. And I also panicked because I also did not understand what was
Mm.
going on, and I was just like 25, 27 years old. I told my broker, let's sell this. He said, why are you selling? You need the money. I said, no, no, no. Planes are crashing into buildings and people are dying. What is the point of having money in stock? Let me sell this. The only good thing is that, I sold half of my position. He sold it. We got the money 3 years. 3 days later, and today, 25, almost 20 plus years later, if I had not sold what I had sold on that day, I would be sitting on almost a 50x return at the price at which I sold it. 50x return. So a lot of us make this mistake, and this is what I give as an example to everybody, that don't ever sell in panic. If you have something which you have bought for a particular reason, you have created a portfolio. If the markets are falling, please don't sell just because the markets are falling. Second is something which we have already discussed, asset allocation. Never overextend yourself only on one side, either on buying or selling, or only one particular asset class. So we learned by our mistakes. I tell everybody also that don't make mistakes. I'll give you one more example. During COVID, one or two clients of mine called up and said, redeem everything I have got. The world is going to end. We don't know what is going to happen. Let me have my money in the bank. I told them, if the world is going to end,
Mm.
whether you have your money in stocks or in mutual funds or whether it is in the bank, it is not going to matter. The world is going to end. No, no, but I get comfort seeing my money in the bank. I tried explaining to them a lot. They didn't listen. They redeemed. It was 2020 and we are in 2026. They are still waiting for the market to fall to redeploy their money. So a lot of people will make mistakes even if you have an advisor, but it's only these mistakes
Yeah.
where you will learn from.
So, sir, I was reading this interesting stat, right, where it was written that the most money is made by people who are actually dead, right? Because they actually don't do anything with their money. So, why is doing nothing often the hardest but the smartest thing in
Yeah.
investing?
Yes, yes, that was a fidelity study which was done in the US, and HDFC Mutual Fund did a similar study in India. They traced their investments which were, done 30 years ago. They found out all the records and then they sent a message to these people that, we congratulate you for making this investment and for holding on for so many years. And a lot of those letters came back undelivered. They found out that the person was dead, so they never knew how much money they had put and what was the current value of their investment. They never came to know what is going on. So the maximum returns were made by people who had died or who were never communicated. They weren't even aware of what their money was doing. This is how that money was created.
So, sir, if someone is in their late 20s or early 30s, what is the one thing that they should focus on if they want to, achieve financial independence one day?
Let's assume a very simple formula. There is this thing which goes on in the market, at least in India. A lot of people don't agree with it, but let me give you a small idea of what it says. It says that you do an investment of 15,000 a month every month for the next 15 years. And if the market gives you 15% return, 15 years later, you will get 1 crore rupees. So let's break it up into numbers. 15,000 every month
Mm.
is 1,80,000 a year. Multiply by 15 years. You have invested 27 lakhs. Your 27 lakhs has become 1 crore after 15. A lot of people are very
Mm.
happy listening to this number and then they say, let's start my investment. Let's start with 15,000 a month. You need to understand that 1 crore after 15 years, inflation adjusted even at 7% will be close to some 40-45 lakhs. So even though you are planning for 1 crore, chances are that the 1 crore
Mm.
which is getting accumulated 15 years later is not going to be worth more than 40-45 lakhs of today. That is where you need an advisor. That is where you need somebody who can sit down and explain to you from their experience that, this is fine. You read this on social media, influencers are pushing this, people are saying do this investment, but no, is it enough? So one, start start small, but keep on adding. As soon as you get an increment, the day you get some extra money, push it into your investment account, put it into your retirement plan, put it into your pension plan. Keep on adding to that number so that by the time, let's say you are 30, 15 years later you are 45, you would have reached to a number which possibly will see to it that you have achieved fire, you are ready to retire. There is no more problem in the world where you need to keep on working from 9 o'clock in the morning till 10, 11 o'clock in the night. Go ahead, enjoy your life. But one, start, start now, start small, but keep on adding.
I think the biggest takeaway from this conversation, right, is that the financial freedom is not just about how much you earn. It's about how you think, how you behave, and how consistently you act over time. So, sir, thank you so much. This was genuinely one of those conversations that makes you pause and reflect, not just on money, but on life itself. Thank you so much for sharing your insights and your time with us.
Thank you, Mihir, for inviting me and asking me all these wonderful questions.
Thank you, sir. Thank you so much. If you found this conversation useful, you'll definitely enjoy the next one I've linked here. And if you want more real conversations like this, make sure you subscribe. I'm bringing one of these every week.